So what we have to understand, as we are giving up control by putting our money away in an RSP and allowing it to grow for some future dollar amount in retirement, that we have locked up the ability to use that money while we are alive. And as that money continues to grow, the larger that account balance on paper is, the less you actually own, because of the amount of tax that the government's going to impose on it.
At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Hello, fellow infinite bankers. My name is Mike, and this is my good friend Scott Cordier from Ontario, and we are here to talk a little bit about controlling your assets in our ongoing quest to give financial literacy to Canadians. We are here talking about the different pros and cons of either using a tax-exempt life insurance contract versus using an RSP, which will then flip into a RIF, a registered income fund at a certain age, or a TFSA. And we're going to talk about some of the pros and cons with all these things, but our focus is about maintaining control and taking back your power about your financial planning, your financial awareness. And without further ado, we've got a lot to cover, so let's just get right into it. Scott, thanks for making the time to do this with me, and yeah, I'm looking forward to a fruitful conversation here. Why don't we start off with some of the pros and cons about registered savings plans, known as RSPs. We're going to talk, maybe get a little bit into tax planning, but both Scott and I are not accountants, and we're not saying that anything that we say here is qualified financial advice or tax advice, but we're just going to talk in general terms about some of the things that the banks and credit unions aren't telling people about RSPs. So one of the things that most people understand about a registered savings plan, commonly referred to as an RSP, is that you get a tax deduction. Most people think, 99.99% people believe that there's a tax deduction going into an RSP, and they also understand there's a tax liability when you come out of an RSP. And what's really super interesting is that most people think about it as being a deduction and liability, but Scott and I think about it as being a deferral of taxes. You still owe that money. When you get a tax return on your RSP contribution, you shouldn't just go blow that on a big screen TV or a trip to Mexico with the family. What you should be doing is thinking long range. As Nelson Nash would say in his book, Becoming Your Own Banker, one of the faults of most people in their financial literacy is that they don't think long range. So Scott, maybe you can just touch a little bit on the difference between a deduction and a deferral.
So it's important for us to understand that an RSP is not really a tax deduction, it is a tax postponement. And not just of the tax today, but the tax growth of that contribution amount in the future. So Revenue Canada understands that the little bit of money they give you today as a carrot for locking your money up for the next 20, 30, 40 plus years is pennies on the dollar compared to the amount of tax that you're going to owe on that RSP as it grows and gets converted over to a RIF. And it'll be roughly 3 to 4 times the amount of tax you're going to owe compared to the cumulative amount of tax that the government, quote unquote, gave you as a refund.
Yeah, and some sort of incentive.
It's a complete incentive, but one of the problems with people having to understand an RSP, the government only has one source of revenue, taxation. If we are currently running a deficit, why are they giving us, quote unquote, tax breaks? It's because they're going to reap the harvest of that amount of money in the future. And ladies and gentlemen, you have to understand, you don't control the tax bracket you're going to be in retirement. The government does. The government's in complete control of what happens. You have no control over the stock market returns, and you have no control over what CRA is going to do with taxation. And we know in the future taxes are going to be higher because we're running a current account deficit.
Yeah.
And COVID just added to that. And as more and more people retire, hundreds of thousands every year, there is less taxable income coming in and more expenses going up because now they're collecting CPP and OAS. And who controls CPP and OAS? The government. So you might not get as much as you were thinking you're going to get because they're going to start clawing that back also.
Mm-hmm. And to be clear, when we compare an RSP tax liability to an insurance contract tax liability, we have to think in terms of when was the Income Tax Act started? Well, it started in September of 1917 under the Temporary War Measures and Income Tax Act. And RSPs are a fairly new thing. In the late 60s, RSPs were started. But insurance contracts have a preferred tax position in the Act because they superseded and were grandfathered by the original Income Tax Act back in 1917 for almost 70 years. The first insurance contract offering a tax-exempt cash savings amount was 1848. So that's literally 70 years before the first Income Tax Act. Now,
Yep.
what's also super interesting is because it's forced income, we're talking about income tax. A lot of people use infinite banking in comparison. They don't get a tax deduction going into the contract, but they know that when they use collateral leverage against an insurance contract, those amounts are leverage, and it's not counted or included or considered to be income. It's considered to be leverage. And we find a lot of people that use their infinite banking policies to, number one, enjoy the use of that money without suffering a tax consequence during their lifetime. And then once they get to retirement, we have to coordinate all the assets that they have to be able to enjoy a tax preferred retirement. Certainly, there are ways of people removing money out of their RSPs. For example, if they get sick, that's still taxable, correct? That's still a taxable event. If they lose their job, they can take money out of their RSPs, but that's still a taxable event. If they take money out to buy a house, for example, in a home buyer's plan, it's still taxable if you don't pay it back under the home buyer's plan rules and guidelines. So,
and you could also look at tax in a different definition, because tax is a loss of money that you had that is now no longer there because it was taken away from you.
Mm-hmm.
Let's replace tax with a home buyer's plan, for example, or tax with a loss of a job during COVID, and you're taking that money out to live on. Let's replace tax with lost opportunity cost. That money is no longer there. So the interest, the growth is gone. That's a tax. It's a silent tax. We don't think of it that way.
No.
But a home buyer's plan, you have this lump sum, and then the government allows you to repay it over 15 years. Think of the growth of that lump sum if you had just left it, and 15 years later, how much more money you would have for your future. So people have to understand that tax, the way we think of it, is blatantly obvious, but tax defined as lost opportunity cost is really a silent killer. And we have lost opportunity costs on everything that we spend money on.
Yeah. And you and I talk about this a lot with our clients, is the difference between using a chainsaw or a ladder and a bucket as your two tool options to reap the harvest of an apple tree. For example, if you use a chainsaw to cut down an apple tree, well, guess what? You're not getting that fruit the next year. You got to replant the tree and wait for a tree to mature to start bearing fruit again, which could be 3, 4, 5, 6 years down the road.
Or with the RSP home buyers plan, it literally could be 10 to 15 years.
Correct.
Right? Like imagine just getting back to where you were 15 years later. That's not a good plan.
No.
So
And the RSP, of course, doesn't have any collateral value. You can't
exactly.
put a loan against, even though you might have 10 million bucks in your RSP because you hit a home run time after time after time. It's unusable to you. And then the tax liability on death is obviously quite significant. I think Nelson points out this idea of you're either going to pay tax on the seeds or you're going to pay tax on the harvest. And if I had a cornfield of which to plant my barrel full of seeds of corn, would I rather have the government show up when I'm planting the seeds or when I'm reaping the harvest? And the harvest could be 10, 15, 20 times that which I've been, or even more.
Which is what you want if you're building up your assets, but literally all you're doing is building up the tax liability.
Yes.
Right?
And
you gave up control of that money.
Yeah. To be clear, if you have a qualified dependent on your death, that RSP will roll over to that qualified dependent. But in the absence of a qualified dependent, such as, for example, a spouse, if you're, God forbid, knock on wood, if your spouse and you pass away in a car accident, doesn't matter when, that becomes, and if you have no financially dependent children, that becomes a fully taxable event. And who's liable for that taxes? Your estate's liable for that taxes.
And let's look at that tax and the loss of control. So let's say that husband and wife each have $1 million in RSPs. They get to retirement. They each pull out 5%, $50,000. You add on CPP, OAS, they're up to, call it 75. They've income split. Now one spouse passes away, the $1 million rolls over to spouse two. Thank you, government, for not taxing the transfer. Oh, but now spouse two has $2 million and is forced to pull out 5%. Now they pull out $100,000 plus CPP. Old age security gets clawed back, which you paid into. So that money's gone. Essentially another tax in retirement. But now the surviving spouse is paying dramatically more money in tax. The government allows for the rollover because it's going to benefit them.
Now,
so once again, that's loss of control. That surviving spouse is now forced to play by CRA's guidelines. And they're the ones who control you as the puppet. They get to pull the strings, increase the RIF withdrawals, increase the amount of taxation, claw back old age security. You have no control.
I was going to just ask you, as you brought up that rollover issue, can you maybe just touch a little bit on what the rollover provisions are in an IBC contract? Again, this is an insurance contract. So what happens with the total death benefit of an insurance contract, Scott?
Well, let me ask that to our audience. And ideally, post this in the comments. If you had $1 million in a RIF, or you had $1 million in a life insurance policy, and you passed away, which would be more tax efficient? Now, I'm going to help you out there with the answer. Life insurance is completely tax-free. Any registered money is going to be fully taxable to the government.
Yeah.
So what we have to understand, as we are giving up control by putting our money away in an RSP and allowing it to grow for some future dollar amount in retirement, that we have locked up the ability to use that money while we are alive. And as that money continues to grow, the larger that account balance on paper is, the less you actually own because of the amount of tax that the government's going to impose on it.
Mm-hmm. Yeah, I think
so the government's done this for a reason.
I think it's very important that we recognize that the government is not a loss leader. They're not going to lose money on anything. So they may be giving you an incentive to do something now, but they know in the background that they are probably deferring. Of course they're deferring right now, but they're deferring a bigger dollar value on average But then what happens, when you pass away is one thing, but what happens if you live too long? Now you run out of money.
Yep.
Why? Because
And,
you're trending down to zero. The
yep,
idea is that when you turn 71, you must flip your RSP into a retirement income fund. That's one of the options. The other option is to cash it out and just suffer the tax consequences of the time. But if you roll that over into a retirement income fund, the government's going to set a minimum amount, which is a rising percentage each year, starts at about 4 or 5% in the earlier years, but then it goes up to when you're in your early to mid 90s, you got to take out 20% a year.
exactly.
So at some point, you're going to run out of money. And
So,
go ahead.
so let's look at this for a second. There have been a number of studies that 15, 20 years ago suggested that a 4% withdrawal was the sweet spot to allow for your portfolio to last you for life.
Yeah.
And then it started to get revised lower and is now somewhere around 3%. So you have all this money, but if you want it to last, you're only allowed to take out 3%. And yet, as soon as you convert to a RIF, the RIF percentage is automatically higher than the 3% rule that's going to allow you to not outlive your money. You've just given up control of being able to dictate what happens with your income. And you still are forced to take an income even when the market crashes. Like, imagine being forced to take out 8 or 9% when the market goes down by 50. It's bad enough it went down by 50, but you just added to it by taking out another 8 or 9%.
Which essentially is 16
control.
or 18% of your total of your prior year's wealth.
Right. So when we talk about giving up control, we talk about taxation, we talk about market volatility and not being in control. You know, the one strategy that you can implement that gives you back all of that control? It's infinite banking. You have no market risk, you have no taxation, there's no volatility, and you are in control of the income stream. And that income stream is tax-free.
Yeah. And again, it's important, we've mentioned this before, but because an RSP has no collateral value, you're putting it in tax jail, that money in tax jail, and you're throwing away the key until such time as you want to unlock that lock and start really attracting back that tax liability that you may have blown on a big screen TV when you got your RSP refund or anything like that. It is only a deferral. One of the things I really appreciate about the difference between what an RSP is, which is forcing you to take money out even when you may not need it. What happens if you sell another taxable asset and now your RIF is going to be on top of the income that taxable sale incurred? A lot of people that are retiring with an infinite banking designed life insurance contract have used that in perpetuity to provide them with access to capital in not only in their lifetime, but also in their retirement. And I think it's really important that we recognize that by the time you're starting to creep up to life expectancy, you are really maximizing the tax exempt compounding effect that's available to you in an insurance contract that's designed correctly. It's not designed for death benefit, but it's important that we remember that if you don't have a need for death benefit, then we're going to have to find another person to get insurance on to provide you that death benefit. We have to think in terms of what the rules and regulation and the legislation is and work within the context of the Income Tax Act in order to design these contracts.
Sorry.
Yeah, go ahead.
So I ask this question every time I'm talking to somebody to help them understand the problem they're not aware of. And this really goes to the heart of this video about giving up control and what you can and cannot control.
Yeah.
So let me use you as a guinea pig. You're heading close to retirement. there are four things that you have to essentially come to terms with. The first one is when you want to retire. Do you have control over that?
Mm-hmm.
Okay. Two, do you have control over what the stock market's going to do with the 20, 30 years of life after you retire?
Mm-hmm.
Do you?
No.
No,
I wish I had that kind of control.
exactly. Do you have control over what the government's going to do with tax brackets for the 20, 30 years after you retire?
I probably am wanting more control over tax brackets than the stock market returns, Scott.
But do you have control over that, or does
Zero.
the government?
I have zero control over that.
And do you want to live as long as possible?
I won't ever get away from death and taxes. So yeah.
Okay. So now you have longevity risk. The longer you live, the more you're going to be forced to take out by the government, and the longer you're going to be exposed to tax. So out of those four, you only have control over one of them, the year that you're going to retire, right?
Mm-hmm.
Does that make any sense that you have no control over 75% of your retirement feature?
No, zero. Makes zero sense.
Would you want to have control over 100% of it?
Even anything more than 25 would be a benefit to me.
Then that is where infinite banking comes in, because it
Mm-hmm.
replaces all that lost control that you currently have given up to good chance, but purely by chance. And that is really important, that we have to understand that this financial planning concept is destined to fail. Now, a lot of you are going, yeah, but I got a lot of money inside my RSPs. I bought Bitcoin or Amazon, Netflix, etc. That's on paper. The more money you have, the less you own, because Revenue Canada becomes the largest shareholder.
Yeah. And it's
And you
important
can't
again.
use that money.
It's very important that we remember that even though an RSP has a beneficiary, if they are not financially dependent on you, it is a taxable event. If you have a third party, if you have a non-financial, financially dependent child, a spouse is considered a financial dependent. So as long as you have a qualified spouse or a qualified financial dependent, that will roll over. Comparatively to an insurance contract, which you can name anyone you want to get the tax exempt rollover, the tax-free rollover of the death benefit, which is going to include your capital, because it is providing an increased death benefit to the original contract. I think that's a very important thing. They both have beneficiaries, but one is taxable. Now, let's just assume, Scott, that couple that you referred to earlier, which had a whole bunch of RSPs, and then they both passed away, unfortunately, in a car accident or something like that, or they passed away fairly soon within each other, maybe a couple of years or something. And so there's still the larger balance of the RSP. To your point, the liability doesn't go away just because they're not around. Well, now the liability is realized, and if your estate doesn't have enough money to satisfy the tax bill on those RSPs, you as a beneficiary may be severally and jointly liable for those taxes, which is also a very important consideration. People need to plan for tax, and they need to plan for the reality of tax. Nelson Nash says this. He says most people fail financially because they don't think long range enough. And I think we get all caught up in the marketing done by financial institutions saying, oh, come get your RSP. It's great. You're going to get the quasi cash deduction or the tax deduction, right? We know it's just a deferral, but they're going to sell it to you as a benefit in the now. And you can use that money for whatever you want. Back when I was working for financial institutions, I used to tell people, you better put that tax return back in your RSP, because you will pay for that in the future. If you go on a trip or buy a big screen TV or buy a new car or something with presumably a cheap car with your tax return on your RSP, that's not going to go well for you, because you still have to consider your future tax liability. So I think we've kind of hammered RSPs and RIFs enough. Why don't we switch the conversation now into a TFSA, a tax-free savings account? And let's talk a little bit first about how this works. So a tax-free savings account works almost exactly the same as a contribution into a life insurance contract. A premium into a life insurance contract is non-deductible, and neither is a contribution to a tax-free savings account. When you take the money out of a TFSA through either a withdrawal or using that tax-free savings account as collateral security on a loan that you arrange with the bank, there's no tax implications. Now, with an insurance contract, it's very important that there's a whole myriad of tax rules that go into an insurance contract, which could make certain loans taxable and could make certain withdrawals taxable. So you want to make sure that you're working with an authorized infinite banking practitioner with that is working with IB Canada Group, preferably, of course, because why? Because they're going to be able to educate you and lead you through how to access that money in a tax preferred manner. And to your point, Scott, you know, if on my retirement, if I'm invested in the financial markets and 75% of the returns and the tax I have no control over, whereas literally 100% of the decisions that I make I have options, right? 100% of the decisions, and depending on what options I choose with my insurance contract, I can significantly reduce the tax liability, and not only my tax liability, but also the direction that I make sure that where my money is going for my estate, for the discretionary amount of income. I'm not forced to take any money out of either a tax-free savings account or an infinite banking policy, a tax-exempt life insurance contract, as we would describe it in Canada. But I think what's really important is the flexibility of the increased deposit options with an insurance contract. For example, I can only get a TFSA in my name, but I could have a tax-exempt insurance contract on my grandchildren. As a matter of fact, there's many books written about how the Rockefellers have used insurance contracts as a wealth creation tool in the Rockefeller Trust. So when I'm old enough and have grandchildren, and I'm not looking for any new grandchildren in the next little while, please, kids. But when I do have it, you know, I can purchase an insurance contract on my grandchildren, and the ownership can cascade down after my death to either my children or maybe even skip a generation. And it's almost like having a tax-exempt trust. It works almost in the same way. It's a storage of capital that can go from generation to generation without triggering tax. And of course, a trust, if you have assets in a trust, and if you've talked to your accountant about that, you're going to have the problem of the 21-year rollover rule in a inter vivos trust or even in a testamentary trust. So that's a huge benefit to an insurance contract. So let's go back maybe and just talk a little bit about what a TFSA is and how you can control both the contributions, the withdrawals, and the investment options within a TFSA, Scott.
And while one thing that you just mentioned is still, you know, burning in everybody's ears, you can't do a TFSA for any of your children.
No.
So a TFSA is limited to the depositor and the owner, and that's it.
No.
And is also limited to a whopping $6,000 a year contribution. So it's very limiting in the amount of room that you can shelter. And it's really interesting to understand where the control lies and where Revenue Canada wants you to focus. You can do 18% of income up to $27,000 into an RSP, where the government's going to reap the benefit of taxation for the rest of your life. Or you can put in a maximum of 6,000 to a vehicle where they won't tax it. So automatically right there, you know where the government wants you to put the money, where they've given you the biggest amount of deposit room, because that's going to benefit them. But the TFSA, once again, is just completely in your own silo. You own it, you're the depositor, and away you go. When we're looking at the insurance, as you alluded to, the insurance can be on multiple different people. I could have multiple different policies, multiple, let's call it mini TFSAs. But I get to control all of that. And I get to have it in a vehicle where I have no opportunity for loss. That does not exist in a TFSA unless you're going to buy a GIC or you're going to put it into cash. And automatically your rates of return are dramatically diminished at that point.
Yeah.
Also, within an insurance policy, not only do I get the death benefit, which is going to be dramatically more than what I'm going to get if I put the same dollar amount into a TFSA, but I also get the ability to deposit more money in there than the TFSA room that's set up by the government allows me to. So once again, the government controls the TFSA room, but I might be able to put in $10, $15, $20, $30,000 as a yearly deposit to my policy, which acts just like a TFSA, tax sheltered growth, in the ability to take an income that's tax-free. But the big difference here is you give up control of the asset when you decide to use the TFSA for a purchase, for income. At that point, you're literally taking that money out of circulation and spending it, which now means it's no longer there for you to ever earn income on again.
It's there for somebody else to earn income on.
Right. You've transferred it to somebody else and they're going to make all the money on it. Yeah. But you now have taken that money out of circulation. And not just that cost of like a $5,000 vacation, but the lost opportunity cost because that $5,000 is no longer in your control. And I define that as a tax. That lost opportunity cost could be $10,000, $15,000, $20,000 that I'm being penalized like a tax is, a penalty for using my own money. Within an infinite banking policy, I don't lose that money. I recapture it, and that asset continues to grow for me for the rest of my life. No. And then I get to pass that on to my kids completely tax-free.
I think you bring up a really important and crucial point, is that when people are comparing, should I do an RSP, should I be doing a TFSA, or should I be, I need a third hand here, or should I be doing
there it is.
Thank you. Tax exempt contract designed in the way that an infinite banking policy should be designed. This is not a comparable of should you invest or should you save. And I think that's really, really a key point here. You can go into cash in a TFSA or RSP. You can go into the financial markets in a TFSA and RSP. You can't go into loans. You can't lend out your money and generate a return on your RSP. You used to be able to do that 20 years ago with a self-directed RSP where you could get a mortgage actually, your own mortgage into your RSP, but that's off the table now. Why? Because banks don't make money on that, so they don't want to do anything that they lose money on, just like the government, incidentally. Now, when you're saving and storing your capital prior to using your capital in the way that you see fit, and this is the key, is that it's the way you see fit. An infinite banking contract will allow you to use the money as you see fit, not based on the investment choices that the financial industry wants you to do, because you're very limited in terms of your RSP. You have a little bit more flexibility, I think, with the TFSA, but very marginally, right? Very marginally. What qualifies as an investment in an RSP is usually what qualifies as an investment in a TFSA. However, we're not talking about investing using an a tax-exempt insurance contract, we're talking about building your pool of capital so that you can do more of what you're already doing. If you're already using a TFSA, then why don't you use an infinite banking policy to further stack your odds to do more of your TFSA? Maybe you haven't contributed your lifetime limit yet. Use your policy to have money working over here that you're not losing, and use that as collateral to be able to do the things you're going to do. Most people that we do business with, a lot of them are in the real estate industry as either investors or professionals, or they've got a rental property, something, and they use their infinite banking to multiply their wealth in real estate. But you don't have to use your policy to multiply your wealth with real estate. How about you start with paying off your credit card and using your infinite banking policy to pay off your credit card, to pay off a car loan, maybe to send a child to university? Why don't you use the capital? Because Nelson said it's all about the way you think, and it's based on your imagination. So you open up that imagination. Now, what are the endless possibilities of using my infinite banking contract to presumably do whatever I want? What if I want to go on vacation and use the cash value of that capital position in my insurance contract to do those sorts of things? I think that's a really important.
And without interrupting that value, it's still there.
Correct.
If I use that same $5,000 in my TFSA, it's not there anymore.
Yeah.
And it's not there for the rest of my life.
Yeah. I think it's also.
And that's a lot of control.
No, sorry to interrupt you, but I think it's also important to remember, and I can't remember if I've said this before, so I'm going to repeat it. 1917 was when the Income Tax Act came into the Federal Temporary War Measures and Income Tax Act started in September, was passed as legislation in September 1917. Insurance contracts were around for almost 70 years before that. Yep. An RSP, a TFSA, universal life insurance contracts have gone through more legislative revisions and changes compared to a whole life insurance contract because of the preferred asset class that the Income Tax Act treats that asset as being preferred compared to a universal life, which they came out in 1982. Compared to an RSP, which came out in the late 60s, and TFSAs in the late 2000s, or the mid 2000s rather. Yep. These things are temporary government solutions to problems the government created.
Exactly.
And that's a very important thing, is that there is some grandfathering going in where an RSP, a TFSA, and universal life may or may not have the same grandfathering potential within the Act.
So you alluded to something which I don't think you actually acknowledge, but the ultra wealthy, those who are making 7-8 figures, they don't do RSPs.
No,
they don't do TFSAs. They don't lock their money away in some vault that they're not going to get access to for 20, 30, 40 years. They don't put it in storage. They keep it actively moving. The banks do this all the time. So when we look at the vast majority of the money is held by the few, why are we managing our money like the majority? If the wealthy know what to do with money, and they do infinite banking, then this should be a wake-up call to the rest of us that if we want to make a difference in what we're doing, we have to break free from the traditional narrative of financial planning, stocks, mutual funds, RSP, and being essentially giving up control of the whole process, giving up control of being able to use the money while we're planning for retirement, so we can use it while we're still, working.
Yeah,
this is a big issue, and this whole video that we're putting out there was about giving up control. We give up control regarding taxation. We give up control regarding market volatility. We give up control regarding our income. We give up control of being able to use the money because we've segregated it for some event 40 years down the road, 30 years down the road. And we don't realize that we're doing this, and we need to take back that control to be able to have complete and active liquidity to be able to take advantage of opportunities.
Yeah. As they may arise.
Yes.
Yeah.
And keeping it away from government meddling as much as possible.
Yeah. So Scott, at the end of the day, I mean, we're not saying that an RSP or a TFSA or an infinite banking, I mean, that's not the point of this video. The point of this video is really to point out to those of you who are watching that there are options and alternatives that you should be considering. And this is just a scratching the surface of what information that you really need to get into when you talk to your authorized infinite banking practitioners. And we've got a huge amount of resources that we already have, and we're putting out a lot more resources. But go to our practitioner finder on the site ibcanadagroup.ca and look up the infinite banking practitioner in your area, and you can have a much more thorough discussion and get your questions answered, because I think informed consent, and I think this is really what the crux of the matter is that because banks don't guarantee you anything in the markets, and the only thing that they guarantee is their fees, we're here saying that may or may not be your best option. But do you know what your best option is? If you haven't looked at the alternatives, because they don't offer the alternatives, they're not going to talk about the alternatives. Why? Because they are a captive. They're like government. We're captive by them in terms of we are a captive audience. And I think it's really important that we consider and weigh out, is infinite banking the right strategy for me compared to using a TFSA or RSP? Well, let's have a conversation about that and let's find out.
Right. And anybody who's, watching this is already questioning whether or not what they know to be true is actually true. They're looking for a solution.
Oh.
So if you're not quite ready to jump onto the, our site and talk to an advisor, make sure you like, subscribe, and smash that bell. So when we send out new videos, you get a chance to slowly start to digest more information regarding infinite banking.
Yeah.
And at some point, you'll want to talk to us because you will understand what you currently don't know.
Yeah. So I think, Scott, we'll sign off from here. But for those of you who have stayed with us through this video, congratulations. And go visit us at ibcanadagroup.ca. And take care and have a great day.
IB Canada Group, your independent authority for information on the infinite banking concept.